What's going on, everybody? It's Jeff here. Welcome back to the channel. AMC up at 15% intraday following GameStop's lead after yesterday they officially announced their 4-to-1 stock split that is going to take effect July 22nd. I haven't done an AMC update in quite some time. We are starting to break out of that ping pong channel that we have been in, and I've got some very important news I want to go over. So let's get right into it. First off, as you can see, a solid uptrend all day long. Volume is average, I would say a little bit over, about 57 million shares traded. We still do have 15 minutes heading into the close. Adam Aaron did recently tweet the question when Pounce, referring to the ape army, asking questions about when he is going to take action against the short sellers. Although he has been a little bit slow, his commitment has remained very solid in trying to fight against market manipulation, especially because he almost lost the entire company as it was shorted into oblivion. I do see this article saying why AMC is up 13%. It's a little bit more to it than just this entire tweet. However, it does spark some interest from retail traders. Next thing is the call option flow has been very well. It's a 3-to-1 call ratio, and as you can see, AMC is at the top of the list with about almost 450,000 contracts traded just as of today. It's about 3-to-1 call to put ratio. As you know, the higher call flow can lead to a gamma squeeze going forward. But let's talk about the most important thing that was released yesterday: the Federal Reserve minutes. The minutes are nothing but a written confirmation from the previous meeting that was held in June. A couple things remain very consistent. All right, the policymakers on the FOMC were prepared, if necessary, to eventually raise interest rates to levels deemed particularly restrictive to the economy in order to crush red hot inflation. Okay, and at the time there was some concern that economic growth and the labor market were cooling, but officials were much more worried that inflation was at increasing risk of becoming entrenched at higher levels in a very short term. Inside these minutes, which we're going to cover more specifically in just a moment, the Federal Reserve is committed to fighting inflation, maintaining maximum employment, and price stability. And they are continuing to say nothing is going to get in the way of that, meaning they're not going to bail out the stock market. They're not going to bail out the bond market. And more specifically, they're not going to bail out any institution, fund, or bank that is over leveraged. So let's talk about this thing that was very important inside this month's release, which was just released yesterday. And I'm also going to cover last month's, and how it coincides. Participants remarked that moving to a restrictive stance of policy was required to meet the committee's legislative mandate to promote maximum employment and price stability. In addition, such a stance would be appropriate from a risk management perspective because it would put the committee in a better position to implement more restrictive policy if inflation came in higher than expected. In a very short term, they are prepared, if inflation does come in higher than expected, to ensure that the monetary and liquidity issues that we are facing does not fall apart. You've already seen articles. If you haven't, you can go look it up on Google, of liquidity issues. And actually there are people inside banks really trying to get cash. Liquidity is nothing more than turning something of a tangible asset into a cash value. That's why you see some of these low volume pumps. If you look at the S&P, or SPY as of today, you can see that right now we are moving to the upside. However, at market close, almost market close, 54% of average volume. You've heard me talk about these liquidity grabs numerous times before. The Federal Reserve is basically saying, listen, you are on your own. We have a job to do. Our number one job is maximum employment, price stability. Beneath that is combating inflation. That's what the Federal Reserve's job is. It is not to, bail out, big banks, bail out, over leveraged funds. So this is something that was stated, which is a little bit different from the tone that we've heard of before. Now, let's talk about what was said inside the May minutes release. Central counterparties needed to remain capable of managing risks associated with heightened volatility, or that margin requirements could give rise to significant liquidity demands for large banks, broker-dealers, and their clients. They've already stated there could be severe liquidity demands, which what we are seeing. Okay. Now, in times before, you've watched the Federal Reserve step in to bail out the economy. Okay. You watched it happen in March of 2020. The Federal Reserve had to jump in, lower rates, push out massive stimulus, okay, in order to bail out the economy from what was happening. You've also watched the Federal Reserve step in times of liquidity crisis, such as '08 and '09, when there was a massive panics, when banks, institutions, and funds were way over leveraged. Okay, when you watch the whole mortgage-backed security division completely implode, and the Federal Reserve once again stepped in. However, both those times, definitely more in 2020, they had the means to do so. And the Federal Reserve is now stating that, listen, we don't have the means to do so. We can't lower interest rates because of where we're at right now. We have a massive amount of debt. We have inflation and price stability that is running rampant out of control. We also have demand that is only showing very small signs of slowing down, meaning even though prices are increasing, consumers are still spending. Okay, and in order for us, the supply chain to catch up and inflation to really cool down, that demand has to drop. So the Federal Reserve has stated, although there's going to be liquidity issues, we're not going to jump in. This is why I am seeing, you might see not only a potential liquidity grab where you're watching these shorts just wait for a bigger move, okay, to the upside in order to capitalize more to the downside when it comes to the entire market. As we've talked about before, 55% average volume, and we're moving, from 385 to 390. This is a nice move to the upside, solid, with just not a short seller in sight. We're also watching stocks like AMC, which are potentially, insanely, I shouldn't say potentially, we know they are insanely shorted, potentially moving to the upside in order for, some of these short sellers to say, listen, we don't want to have liquidity issues, especially if we do get into a position where margin requirements are raised. Okay. And if the Federal Reserve does see, inflation continuing to run hotter than expected, they're going to need to run a tighter and more restrictive policy. It's going to affect every single fund and institution going forward. This could be another issue or another issue for the funds and another reason why AMC is running hotter. So guys, that is it for this video. Catch you in the next one.